Okay, we're back. So our stopping point for the first video lecture was the balance sheet. And once again, the balance sheet is a statement prepared at the end of the accounting period to identify the total assets of a business, their total liabilities, and their total stockholders' equity. So again, your job is to understand what are assets. You must understand what do liabilities represent and what type of accounts are shown up on the stockholders' equity section of the balance sheet. And when you are preparing the balance sheet again, it must be in balance. The total of your assets must equal your total liabilities and the total of your stockholders' equity. Once the balance sheet is prepared, we're going to go to another statement, which is known as the statement of cash flow. But again, I want to make sure on the balance sheet you do understand that with the heading of the balance sheet is not for a period of time. The balance sheet is for a specific date. So the balance sheet shows each account balance as of a specific date. And for the retained earnings, this amount shown here is coming from the retained earnings statement. This would be the ending balance shown on the retained earnings statement. It is transferred over to the stockholders' equity section of your balance sheet. This next statement is a statement known as the statement of cash flow. The statement of cash flow. This statement identifies the type of activities that has caused the change in our cash account from the beginning of the accounting period until the end of the accounting period. So you begin, of course, with your heading again. That's the who, the what, and the when. The statement of cash flow is for a period of time. It says for the month in October 31st of 2017. When you think about a company's business transaction, they fall under three categories: operating activities, investing activities, and financing activities. When you think about operating activities, think about the day to day operations of the business. So, think about your place of employment. What is it that you do on a daily basis? It could be selling a product, it could be providing an actual service. So think about your operating activities. These are those daily type of transactions that we run every day in order to operate our business organization. So for this section, we'll show the cash receipt that came in from operating activities. So mainly, this will show the money that came in either from selling products to our customers or providing a service to our clients, or once again, it could be a combination of the two. Because there are some companies that do both. There are certain companies that provide both a service as well as sell products to the actual clientele. This next slide shows cash payments for operating activities. So this could be money we pay for supplies, for salaries to our employees, paying rent, paying insurance, advertising. These are the money that we have to spend in order to operate our business organization. We're then going to net the cash inflows from the cash outflow to determine whether there was an increase in cash from these operating activities or the cash decrease because of this. For this illustration, the cash inflows exceed the amount of the cash outflow. Therefore, we have net cash provided from our operating activities in the amount of $5,700. Next, you have your investing activities. When you think about investments, think about the acquisition of what we call long-term assets, whether on buying a new equipment, building, land, new automobiles, or it could be selling those items as well. When you think about investing activities, you want to think about the acquisition of long-term assets. If I buy stocks and bonds of other companies, that's also an example of what's known as investing activities. So again, when you think about investment, focus on what we call long-term assets. The acquisition of some type of tangible asset, such as land, equipment, machinery, or the purchase of stocks and bonds of another business organization. For our example, we purchased office equipment. If I bought equipment and I spent cash for it, that's going to be an outflow of cash. It's shown as parentheses, which means negative. So from investing activities, we have net cash used in amount of a negative $5,000. And our goal is this. If I look at my balance sheet, I see that my ending cash balance was $15,200. Because this is my first month of operation, my beginning cash balance was zero. We're trying to figure out what type of activities caused the increase in my cash account. Did it come from operating activities? Did it come from investing activities? Or did it come from financing activities? So speaking of financing activities, there are mainly two types or categories of financing. There's debt financing, which is known as liabilities, or equity financing, which is known as stockholders' equity. Let's begin first with equity financing. What happens when a company sells a share of their stock? I'm waiting. That's correct. What they're doing, they're selling ownership interest into their business organization. So if you have ownership of one share of common stock of any company, then guess what? You are a part owner of that business organization. So what this is showing is the increase in cash that came from the issuance of common stock. That amount was $10,000. Next, we have debt financing, which means we're simply borrowing money. So if a company borrows money from the bank, there's going to be a contract known as a promissory note. And from an accounting standpoint, we have what's called a notes payable account, which means that we have borrowed money and we're going to agree to pay that money back at some point in time in the future based upon a specified interest rate, which will be listed in the actual promissory note. So for our example, we borrow from the bank $5,000. So we have an increase in cash of $5,000 from this financing activity. Payment of dividends. When you are a stockholder, when you buy common stock of any company, for you, that is an investment. So as an investor, it's saying, how do I make money off of my investment? In one or two ways. Either I'm going to sell my stock at a price higher than what I paid for it, or I'm going to receive what's known as dividends. So on occasion, corporations will pay out dividends to the stockholders of the corporation. Because in essence, if I am a stockholder, I am part owner of the business. So if the business has made a profit, then essentially as a stockholder, I am entitled to a percentage of the actual profit. So dividends are paid by corporations to the stockholders, but it means there's money that's going out. So when you pay out dividend, that would be a decrease in cash as a financing activity. So we have the increase from issuing common stock, the increase from issuing a notes payable account, and then we have the decrease from paying out dividend. So from our financing activities overall, we have a net increase in cash in the amount of $14,500. Now, the beauty of the statement of cash flow is that you will know, based upon your beginning cash balance and the ending cash balance, the amount of the increase or decrease in your cash account. The key is what type of activities cause my cash account to increase or decrease. So I'm going to add up the net cash from operating activities, 5,700, minus the 5,000 from my investment activities, plus the 14,500 from my financing activities, which give me an overall net increase in cash in the amount of $15,200. So when you're asked as the accountant, what type of activities cause your cash account to increase? What would be your response? So mainly our increase in cash came from the issuance of common stock, as well as we borrowed $5,000. We also had an increase in cash from our operating activities, but we did spend $5,000 on purchasing of new equipment. So once again, the statement of cash flows, this statement shows the increase in our cash account that came from our operating, our investing, and our financing activities. So this is going to conclude our Chapter 1 video lecture. Again, the statement of cash flow answers questions such as, where did the cash come from? How was cash used? And what was the overall change in our cash account during the accounting period? So make sure that you can prepare from this chapter an income statement, a retained earnings statement, a balance sheet, as well as a statement of cash flow.